Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back. This is Real Estate Radio, and I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate Radio is designed to build the Washington, D.C. Metro's housing and credit markets by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030, or realestateradio.dcmetro.com. So, great article. Actually, was more of commentary on CNN because that's what they like to promote, a lot of interaction with Facebookers and everything else. But the headline, Lewis, was, "What about us? Responsible homeowners left out in the cold. Responsible borrowers have good credit and make their payments on time are being told that the only way that they can refinance is if they start defaulting on payments." Now, you know, I've been going back and forth on this because I think that I brought my idea to you many months back that if the consumer or the person that actually is paying the mortgage and they've been on time for the last 12 months, 24 months, never been late, that we should actually be able to develop, and I hate to say this, it's going to have to be some sort of government program or government backed, but to allow a consumer to be able to refinance even if they're upside down. Now, with the Fannie Mae and Freddie Mac program, they do allow you to go up to 120% of what your home is actually worth. However, you have to currently be in a Fannie Mae or Freddie Mac mortgage, or you don't even qualify for that program. I said that, as long as, you have perfect credit, as long as you've been making your payments, anybody should be eligible for this. And I don't know if it's actually feasible to do that, but I could see this would be a major way to maybe stop or slow down the amount of short sales and foreclosures that we've had out there. Would you agree, Louis?
Yep.
I mean, we're talking about, I know, when you're talking about the banks and how greedy they are and everything else, I mean, ultimately, they're lending out new money at today's rates. So what's the difference in lending out, customers that have been paying you on time for 5 to 7 years, the same rate as what everybody else is getting today? Prevent yourself from actually having to, that borrower strategically defaulting on their loan, or letting their house go to foreclosure, which ultimately costs them probably $67,000 in fees.
But I don't understand why the banks wouldn't do it otherwise, other than they're probably a smaller subset, and they're focusing all their efforts on those that are in default or in foreclosure.
Well, I think one of the big components of it is the way that these loans were securitized, meaning you'd have to go back and unbundle them, and you know what I mean?
Well, there's that too, but then there's no way of knowing. It's almost if somebody is paying, they think then there's not a problem. And I know I've heard many cases where people have called up and have tried to, I think Mitch Ribbeck of Florida, we had him on the show,
yep,
where they call up and the bank tells them, no, you have to be and you have to be 3 months late before we'll even talk to you. But then you call up again and you might get somebody else who might help you.
Yeah, and it's interesting because I work with a great real estate attorney with Metropolitan Title, and they mainly handle a lot of short sale transactions. And really what they do is since it's an attorney that's actually handling the short sales, they tend to talk to people that are more in charge than if it's just a real estate agent handling it. And what was interesting speaking with him is that, he's like, people try to continue to pay their mortgage until they're down to their last dime. And then when they're down to their last dime, they're like, what do we do next? He actually is a big advocate. When you see this coming, maybe 8 to 12 months out in advance, that's when you should really start trying. And a lot of these responsible homeowners, that's when they do start making the calls to the bank to say, hey, look, this is our position. Yeah, we've been paying you on time. We want to pay you on time, but we're getting rid of all of our reserves or the money that we have in savings to continue paying you.
Well, doesn't the bank also want to make sure or try to keep at a certain level the number of actual performing loans?
Yes.
So they probably don't want to start down that road because most people will raise their hand and say, how about a loan mod?
But you know what? They could treat it as a loan modification and not a refinance if they wanted to. They could just modify that loan, and what they could say, I would see if I'm the one, I'm pretending like I'm the bank. I wish I was, because I could help a lot of people. But what I would do is I'd say, okay, we're going to put you into a temporary modification at this lower rate. Let's just say that, that rate that I was quoting on a 30-year fix is 4.37. Be like, okay, we can't give you that rate, but we can give you 4.75. So maybe a 0.5% higher than what everybody else is getting, still very low. And it's temporary for 1 year. If you perform and make all your payments on time for that 1 year, we will convert that to a permanent modification that you will then have for the remaining 29 years. There's nothing wrong with that. Very simple, right?
It's common sense to me.
It's common sense.
Lending sense, sure.
And what's funny is they say that pretty much 80 to 90% of all modifications that they're currently doing are failing. There's a reason why they're failing, because they're not giving favorable terms.
Well, they're getting them at the point where the borrower is in desperate straits.
Yes.
If they would get them where you're saying up front,
yep,
and modify before the problem happens, instead of being reactive. They
try to classify a hardship as like losing your job or a death in the family. A hardship is when somebody took a pay cut and is basically using all their savings to stay on top of their bills. And eventually, that, just like anything else, I mean, they're kicking the can down the road just like the government's going to do, and except what's going to be the ultimate end-all for the consumer? They're going to have to go bankrupt, or they're going to get foreclosed upon. Those are their two options. They don't have the luxury of the Fed printing press to continue to print money to pay their banks, right?
But as you see, people don't, companies, governments don't want to deal with issues until they actually arise. They're not taking preemptive action.
Yeah.
And working with these customers, these borrowers who eventually are going to end up in a situation where they're going to have to do a short sale or foreclose.
Yet at the same time, they complain about the amount of foreclosures that are out there. You know what I mean? It's like, no, let's not be proactive. Let's just complain about it, and then we'll keep trying to come up with another 4-letter government program that's going to help. 0.001.
3-letter ones too.
And 3-letter ones too. I forgot about those. Well, you're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. And we're talking about responsible homeowners that are left out in the cold, meaning you guys that have been paying your mortgage on time and just are unable to refinance because you're upside down. Now, I do want to offer one tip, and I had a client, Louis, this is probably about a month or two ago. The situation was, they were upside down, probably about $20,000 or $30,000. Okay, they have a retirement account, a 401k that probably had about $400,000 or $500,000 sitting in there. They were at a 5.75% interest rate on a 15-year fixed. And they were like, we really want to refinance so we can get down there in the threes on a 15-year fixed and really, lop off a lot of the interest there and be able to pay this off as soon as possible. And I said, okay, well, you don't really have much money saved up in your bank. You'd have to come to the table with the difference. So after looking at their 401k, and this is a lot of people's position, actually, because a lot of people do pay into their 401k. They pay into some sort of retirement, and a lot of people actually have access to borrow against their 401k. Okay? Now, I'm not going to say this is going to work for everybody, but for this couple, it did, and I would say that it's probably going to work for another 30 to 40% of the people that do have 401ks. We actually went ahead, we did it, got an appraisal, found out what that was, found out the amount that they needed to borrow from their 401k. They were able to borrow from their 401k at 4% interest. Okay? So we actually effectively borrowed, I believe it was about $50,000 to $60,000 at that 4%, and we were able to lower from a 5.75 15-year fixed down to 3.5 15-year fixed. Okay? This is a family that thought that they had no chance in refinancing. And it was kind of, you're having to strategically, maneuver money and figure out where you're going to pull it from. But it really, even if you take the 4% that they had to borrow their 401k from, they're still netting out somewhere around, 3.625, 3.75%. So it was a win-win for them. And there's a lot of you out there that are in similar situations that are just, you're hovering around that 5.5% to 6.5%. And you're really like, if I could just get down into the fours, I might be able to make this work. This is an option for you. The best advice I can tell you is to reach out, 877-245-2030. That's 877-245-2030. I would be glad to speak with you on an individual basis just to kind of, look over your complete finance plan and say, you have options or you don't have options so that you can make a decision now is if you see, a short sale or foreclosure is imminent for you because you don't really have the monies to keep up with it, that this might be a way to go ahead and get that refinance done that you otherwise couldn't do. I know out there, on the West Coast where you're at, Lewis, I mean, you probably have a lot of homes that are upside down as well, right?
No, plenty.
Plenty. And I mean, this is a very good, viable option for people that I don't think a lot of people consider. I think that for people that you really want to stay in their home long term, that borrowing, I mean, it is their money essentially. They're just borrowing their own money.
Well, one of the things is people, the two things that people are told constantly is real estate is the best investment and don't take money out of your 401k plan. So you're doubling down on those two cliches there because a lot of people are reluctant to borrow against their 401k plan.
Yeah, I'm not. To me, though, a lot of these people, when you have the ability to borrow that money and to stay in the home that you love and you grew up, either you grew up in or your family, you want to continue keeping them in the same school zones and everything else, and you can really save your family's financial future. It makes absolute sense.
Oh, it does. But when people also hear about people who just decide not to pay, they do the strategic default
Right.
and they do nothing.
Yeah,
that's even more of a kick in the face where you now have to go into your own money.
correct.
To save your house, where other people are not doing anything to save their homes and their credit, they're just not paying. Yeah, and we've heard many of those stories that people don't pay for 2 or 3 years before anything happens.
But that's an interesting point there, Lewis, because you have two options. You can strategically default, right? Or you could be strategic in coming up with a way to borrow money to get into a better financial position, because if you strategically default, you're not going to be buying another home for at least 2 years.
Right.
Versus if you come up with the money from your retirement account, you can then continue to stay in the home that you love and own currently.
Mm-hmm.
You know what I mean? So that's a good a good decision there, one way or the other, whatever you choose. I mean, obviously it seems like it's a lot better to go the other way, where you can save your credit and your home. We are coming up on a break. When we come back, we're going to jump in why you shouldn't fixate on interest rates in a couple minutes. Be right back.